Joining us is Savita Subramanian. She's head of U.S. equity strategy at Bank of America. Savita, I wish you could have been there for the first discussion because we needed a counterpoint, okay?
The first two discussions.
The first two discussions. I'm convinced. I'm totally convinced it's the earnings. It's what do they say? The return on equity for the stock market is so high that the multiple's the lowest it's been since COVID. It all sounds fine to me. So what is that argument missing?
Yeah, let's talk about it. So look, I'm not outright bearish on stocks, and I think there are a lot of really great places to go within the S&P 500. If you had to buy one index today, I would buy the Russell Large Cap Value Index. But I do think that we are at a point where it's really difficult to continue to clock gains from here. And the reasons are manifold. One, I mean, the good news is priced in. Typically years where you've got great earnings growth and GDP growth are not the best years for equity returns. Two, you're starting to see multiple compression in areas like tech. We're seeing supply-demand dynamics change. I know we've all been talking about that recently. But even at the beginning of the year, we started to see buybacks slow down demonstrably within certain areas of that hyperscaler space. The shrinkage argument seems to be behind us rather than ahead of us when it comes to public equity availability. So supply-demand, not great. And then on top of that, I think the liquidity spigot is slowly being turned off. And think about it. This year, we started the year expecting Fed rate cuts. We started the year expecting central bank rate cuts. What are we getting? No rate cuts. And I think that is very important to think about because last year was essentially the best year on record when it comes to liquidity. Everybody was buying equities. You had individual investors. You had corporate buybacks. You had privatizations. You had the government was buying U.S. equities. Everyone was buying U.S. equities. And this year, I think we're getting a little less of that liquidity machine, and we're also getting a big shift in supply demand. So that's why we're bearish at an index level. Within the index, like I said, I think there's a tremendous opportunity to own income, value, areas of the market that are throwing off capital rather than using it. But I'll pause for a breath there.
No. So Savita, I want to bring this up because out of all those things you said, we did have earlier today, we had, again, earnings have been incredibly strong, right, at this point, up nearly 30% in the first quarter. Ed Yardeni was on Squawk Box this morning and said it's fueling the rally. So here's what he said. Take a listen.
I've been among the bulls, and I haven't been bullish enough. I mean, it's really extraordinary. We've been in what I call not a FOMO market, but a FEMO market. FEMO meaning fabulous earnings momentum. Earnings have been unbelievably strong.
There is no doubt, Savita, that we are no longer at the war lows in March, where we don't have a low base to build gains off of, to your original point about, the good earnings years not being the best years for stock returns. But we do have markets at or near record highs and earnings momentum, as Yardeni points out, to justify it. So is there a reason why we shouldn't think that this could at least continue, not off like a rocket ship, but still continue the way that it's been going?
Look, I think that it can continue, and earnings, if they continue to surprise, can fuel added gains. But how much more can earnings surprise at this point? Also, when you look at where we've seen the biggest earnings surprises this year, it hasn't just been technology. It's also been energy. It's been materials. It's been mostly semis within tech. So, yeah, I get it. Earnings are great, but I don't necessarily think this is a market that sets itself up for more positive surprises, given that analysts are now forecasting close to the highest long-term growth rates in earnings that we've seen in the history of our data. So this is the thing. The market doesn't necessarily react to earnings as they happen. It reacts to surprise on expected earnings. Let's think about what's expected. We're expecting 22% earnings growth. I think it's going to be an awesome year for earnings. But I don't know if we're going to continue to see those really strong positive surprises that have driven the market higher. Think about what's driven the market over the last few years. It was a surprise around ChatGPT. It was a surprise around coming out of COVID. It was a surprise around stimulus coming from the government or from the Fed. Those levers, unless they get re-amplified, are not coming back unless we get ChatGPT Chat GPT Part 2, our view is, where the surprise is going to be, maybe in, energy holding up better than we thought it would post a ceasefire, maybe in financials actually starting to enjoy lending growth. I think the economy is doing great. I like cyclical companies with a tether to GDP. I like companies that benefit from earnings growth. But those aren't necessarily the biggest parts of the S&P right now, and that's why I worry about the index.